welcome to the deep dive. Today, we're moving past the 101 stuff. We're really getting into engineering your financial future.
That's right.
We're talking IRA optimization. Think of it as a blueprint, drawing on, well, timeless wisdom, but also some pretty modern, savvy tactics.
Exactly. We're aiming for mastery here. So we're looking at strategies the pros use, blending, say, Warren Buffett's long-term patience with the kind of clever tax plays you might see finance folks talk about, maybe even like in The Big Short.
Yeah, cutting through the noise. The goal is simple. High-yield strategies.
Yeah.
Fighting inflation, fighting taxes, making your IRA work harder for you,
Yeah.
Turning it into a real wealth engine.
Okay, so let's start with the bedrock, the foundation.
Right.
An IRA, individual retirement account. It's basically a tax-advantaged savings tool. Came about in '74, part of ERISA.
And it's huge now, right?
Oh, massive. We're talking over $13 trillion in assets as of 2025. Holds something like 30% of all U.S. retirement money. That scale alone tells you how important it is.
And the first big decision, the one that really sets the course, is the tax treatment.
Absolutely crucial. You've got to pick your powerhouse. It boils down to your taxes now versus what you expect them to be later.
Okay.
So, the traditional IRA, your contributions might be tax deductible today.
Might be.
Well, yeah, depending on your income and if you have a workplace plan. But the idea is, if you're earning a lot now, expect lower income in retirement, this defers the tax hit until you withdraw.
Makes sense. But what if you're young?
Yeah.
Or, you just think taxes are only going up?
That's the flip side. And that's where the Roth IRA really comes into its own.
Okay.
With a Roth, you pay taxes on the money going in, but then qualified withdrawals later on, after 59 and a half, are completely 100% tax-free. All the growth, too.
Wow, that's powerful, especially against rising taxes.
It is, but there's a catch for high earners. Those MNGI limits modified adjusted gross income. For 2025, if you're single making over $161,000 or married over $240,000, you can't contribute directly.
Okay. We'll come back to that, I bet. But quickly, before anyone rushes off to fund an IRA, a key tip.
Oh, absolutely.
Always max out your employer 401k match first.
Yes. It's free money. Don't leave it on the table.
Seriously.
Nice.
What about folks who work for themselves? Side hustles, consultants?
Right. For them, there's the SEP IRA, Simplified Employee Pension. It's pretty straightforward. Lets you contribute a good chunk, up to 25% of your compensation.
Up to what limit?
For 2025, the cap is $69,000. Pretty significant.
That is huge. But I hear people talk about solo 401ks too.
Yeah.
How does the SEP stack up against that? Is one better?
That's a great question. And yeah, there's a difference. The SEP is simpler administratively. Think of it like a traditional IRA, just with higher limits. But it only allows employer contributions.
Okay.
The solo 401k, on the other hand, lets you contribute as both the employer and the employee. Often means you can stash away more in total. Plus, solo 401ks usually let you take out loans, which SPs don't.
So SEP for simplicity, maybe solo 401k for max contributions and flexibility.
Generally, yeah.
Sure.
Depends on your specific needs.
Got it. And one more type before we move on.
The rollover IRA. Essential piece, really. If you've changed jobs, you likely have old 401ks hanging around.
Right.
Use a rollover IRA to consolidate them. Cuts down on fees, usually gives you way better investment choices, simplifies your life.
Okay, so that's the landscape. Yeah. Now, how does this tie into that Buffett quote?
Yeah.
The patience idea.
It's all about compounding. Buffett said, the stock market is a device for transferring money from the impatient to the patient. IRAs are like turbochargers for that patience because the growth is tax sheltered.
Sheltered or even tax-free in a Roth.
Exactly. Look at the numbers. Vanguard ran simulations. $5,000 a year, earning 7%, compounded over 40 years. That can grow to $1.1 million.
Wow.
That's the power of long-term tax-advantaged compounding. Patience pays.
Okay, foundation laid. Now let's get into the real optimization, hacking the limits, as you said. 2025 limits,
Yeah.
$7,000 or $8,000 if you're 50 plus. But we want to show people how to potentially get more in, especially if they earn too much for a direct Roth.
Precisely. And the first big play here is the famous Backdoor Roth IRA.
The Backdoor Roth. Sounds intriguing. What is it?
It's basically a workaround, a form of tax arbitrage for people whose income is above those MNGI limits for direct Roth contributions.
So income's too high for the front door. How does the back door work?
It's a two-step process using different parts of the tax code. Step one, you make an after-tax contribution to a traditional IRA. Key point, it's non-deductible.
Okay, after-tax money in.
Step two, you immediately or very quickly convert that traditional IRA to a Roth IRA. The IRS currently allows this conversion no matter your income level.
That sounds almost too easy, like a loophole. But wait, I remember hearing something about a catch if you already have money in traditional IRAs. The pro rata rule.
Ah, yes, you've hit on the critical landmine. The pro rata rule, this is where people get tripped up.
How does it work? What does it do?
Okay, so the IRS looks at all your non-Roth IRAs, traditional, SEP, simple as one single pool of money.
All of them combined.
Yep. So let's say you have an old rollover IRA with $93,000 in pre-tax money. Then you add $7,000 in new non-deductible money for the backdoor Roth conversion.
Right. Total $100,000 now in traditional IRAs.
Exactly. The pro rata rule says you can't just convert that new $7,000 tax-free. You have to figure out the ratio of your after-tax money, $7,000, to your total traditional IRA balance, $100,000.
So only 7% of the conversion would be tax-free.
Correct. The other 93% of that $7,000 conversion would be taxable income.
Ouch. So the backdoor Roth only really works cleanly if you have zero pre-tax money in any traditional SEP or simple IRAs.
That's the key takeaway. You need a clean slate for it to be truly effective and tax-free. This is definitely advanced strategy, not basic savings.
Wow, okay. That detail makes all the difference. So beyond getting money in, let's talk about how to make it grow, the investments.
Right. Your IRA isn't a piggy bank. It needs to be a growth engine.
What's the approach?
We lean on the classics mostly. The 60-40 portfolio, 60% stocks, 40% bonds is a decent starting point. Use low-cost index funds like an S&P 500 ETF, ticker VOO maybe, and a total bond market ETF like BND.
But maybe more aggressive if you're young.
Oh, absolutely. If you have decades, lean into stocks 80-20, even 90-10. Time smooths out the bumps.
And the golden rule from Buffett.
Avoid high fees. Seriously. High-cost mutual funds are wealth destroyers over the long run. Stick to index funds and ETFs with super low expense ratios. Compounding needs every bit of fuel it can get.
And thinking about that movie, Lucky Bhaskar, is there a lesson there about spotting value?
I think so. It's about avoiding herd mentality, looking for opportunities others miss, maybe staying disciplined when markets get choppy. Use tools like Morningstar to research funds. Historically, you're aiming for that 8-10% average annual return the market offers, according to NYU Stern data. Minimize friction fees, taxes, bad decisions to capture as much of that as possible.
Makes sense. And what about protecting the portfolio? I've heard Sue Zorman talk a lot about tax diversification.
Yes, crucial concept. It means not having all your retirement eggs in one tax basket.
So having some money in traditional IRAs or 401k.
Right. Tax later.
Some in Roth accounts.
Tax now, tax-free later.
And maybe even some in regular taxable brokerage accounts.
Exactly. Having that mix gives you flexibility in retirement. You can strategically withdraw from different accounts to manage your income and, importantly, your tax bracket each year. Fidelity actually found that people who manage this mix well end up with 20-30% more after-tax wealth over 30 years.
20 to 30% more just by being smart about taxes.
That's the power of tax diversification. It's huge.
Okay, that really sets the stage for advanced mastery. Let's talk about those high-income accelerators, moving beyond the basics.
Right. For those who can really push the limits, first up, the Mega Backdoor Roth.
Mega Backdoor. How's that different from the regular Backdoor Roth?
This one involves your 401k, specifically if your plan allows for after-tax contributions, beyond the standard pre-tax or Roth limits. This is pretty common in big tech companies, places like Google.
Okay, so my plan needs that feature. How does it work?
It uses the overall 401k contribution limit, which includes employer match and these after-tax contributions. That total limit is much higher, $69,000 for 2025.
$69,000, wow.
So you max out your regular contributions, then you pile in after-tax dollars up to that $69K ceiling. Then the mega part, you roll those after-tax contributions out of the 401k and directly into a Roth IRA.
Instantly boosting your Roth balance way beyond the normal IRA limits.
Precisely. It's a massive accelerator for tax-free growth if your plan allows it and you have the cash flow.
Okay, that's powerful. What about investing beyond stocks and bonds? Real estate, crypto, startups?
Now you're talking about self-directed IRAs or SDIRAs.
Yeah, companies like Equity Trust help with this.
They do. SDIRAs let you hold alternative assets within your IRA wrapper. The potential upside can be enormous. Imagine holding Bitcoin in your IRA since 2017. That's like 100x growth, completely tax sheltered.
Sounds amazing, but risky.
Extremely. High risk, high complexity. We generally suggest limiting these kinds of alternative assets to maybe 5%, 10% tops of your total retirement portfolio.
Is the main risk just the asset itself, like crypto volatility? Or is there more to it?
Good question. The market risk is obvious, But the bigger danger with SDIRAs is accidentally breaking the IRS rules, specifically the prohibited transaction rules.
Prohibited transactions, like what?
Like using your IRA assets in a way that benefits you personally or your family before retirement, buying a rental property with your IRA and then living in it, or hiring your son to manage it. That kind of self-dealing.
And the penalty is harsh.
Devastating. If you commit a prohibited transaction, the entire IRA can be deemed distributed instantly. You owe taxes on the whole amount, plus penalties. It's a nuclear option. You absolutely must know the rules inside out.
Okay, duly noted. Very high stakes. Let's shift to something maybe less exotic, but incredibly powerful. The HSA, the health savings account. You called it the IRA's cousin.
Yeah, it's powerful tax advantage cousin. If you have a high deductible health plan, you should absolutely be using an HSA.
Why is it so good?
It's the unicorn. Triple tax-free.
Triple.
Yep. 1, contributions go in tax deductible. 2, the money grows tax-free. 3, withdrawals are tax-free as long as they're used for qualified medical expenses.
And you can invest the money in an HSA, right? It's not just savings.
Correct. Most HSA providers offer investment options, so you should treat it like another retirement account, specifically earmarked for future healthcare costs, which are often huge and unpredictable in retirement. Max it out if you can. For 2025, the limits are $4,150 for singles, $8,300 for families.
Wow. Combining an optimized IRA strategy with a maxed-out invested HSA sounds like a serious financial shield.
It's about as close to a perfect tax shield as you can get.
Okay, so we built the nest egg. Now, how do we plan to actually use it in retirement? Withdrawals.
Right. The withdrawal phase needs optimization, too. The starting point is often the 4% rule.
From William Bingen's study back in the 90s.
That's the one. It suggests you can withdraw 4% of your portfolio's value in the first year of retirement, then adjust that amount for inflation each year after, and you should have a very high probability of your money lasting 30 years or more.
And how does tax diversification play into withdrawals?
Smartly. You might draw from your traditional IRA first to cover basic living expenses up until you hit required minimum distributions, or RMDs.
Right, those forced withdrawals later in life.
Exactly. But maybe you want a bit more income one year for travel or a big purchase. Instead of taking more from the traditional IRA and bumping yourself into a higher tax bracket, you pull that extra money from your tax-free Roth account.
Ah, using the Roth strategically to manage your taxable income each year. Clever.
That's the optimization game in retirement.
Okay, before we wrap up, let's quickly cover the pitfalls. Common mistakes to avoid.
Number 1, early withdrawals from traditional IRAs. That 10% penalty plus income tax is brutal. Avoid it unless it's a dire emergency.
But Roth contributions are different.
Yes, that's a key benefit. You can always withdraw your contributions, not earnings, from a Roth IRA, tax-free and penalty-free, anytime. It provides a bit of an emergency fund safety valve, though ideally you never touch it.
Good to know. What else?
Fee creep. Those small percentages add up massively over time. Check your investment fees annually. If you're paying more than, say, 0.5%, 0.50%, you can probably find cheaper options. Switch. It could mean tens, even hundreds of thousands more dollars over decades.
Wow. And the last one.
Over-concentration. Don't put all your eggs in one basket. Remember Enron? We saw that play out in The Smartest Guys in the Room. Diversification across different assets and sectors is your shield against catastrophic loss.
Okay, fantastic insights. So pulling it all together for everyone listening, what's the action plan? How do you go from understanding this to actually doing it?
All right, let's make it concrete. 4 steps. First, assess, figure out where you stand. Use a good retirement calculator. IRS.gov has one to see your trajectory and potential gap.
Okay, know your numbers.
Second, fund. Automate it. Set up automatic contributions to max out your chosen IRA each month or paycheck. Don't wait until the deadline. Start compounding now.
Consistency is key. What's next?
Third, allocate. Set your target mix, 80-20, 60-40, whatever fits your risk tolerance and timeline, and rebalance periodically, maybe quarterly, maybe annually. Just check in and bring it back into line.
Stay disciplined.
And fourth, evolve. Keep learning. Finance isn't static. Commit to reading maybe one good book a year on investing or strategy, Rich Dad, Poor Dad, The Simple Path to Wealth, whatever resonates. Keep refining your approach.
Love it. Assess, fund, allocate, evolve. It really frames the journey.
And remember that quote from Dave Ramsey, wealth is not about having a lot of money, it's about having a lot of options. This kind of optimization using traditional, Roth, maybe backdoor methods, HSAs, it creates those options for you down the road. It takes persistence, like in the pursuit of happiness, but compound interest is working for you the whole time.
Absolutely. So we've talked about the power trio, traditional, Roth, HSA for tax diversification within the U.S. But let's end with a provocative thought, something maybe a bit further out.
Okay, let's hear it.
If you're building serious, potentially generational wealth using these tools, have you considered the global aspect? Even if you don't plan to live abroad, how might understanding and potentially leveraging things like foreign tax credits outlined in IRS Pub 54, for instance, give you even more flexibility and optimization potential for your assets in the future? Thinking about that next layer of global optionality.
That's definitely advanced planning. Setting up future flexibility for international assets or income streams, even theoretically. Interesting food for thought.
Something to mull over. Thanks for diving deep with us today.
My pleasure. Great discussion.